Really excited to have you joining our startup funding series event on investment syndicates. And I think there's a lot happening in this space, and we've got a great group join us for the panel today. My name's Callum Davidson. I look after partnerships at Cake Equity. So I'll be hosting the event today. And on the panel today, we have Stew Glynn from 1013, who's our syndicate expert. We have Karen Nielsen-Field. Thanks for joining us from artificial intelligence. So she's been through the process herself. So amplified intelligence, sorry, not artificial intelligence, has been through the process herself. So it's fantastic to have Karen on the call to actually talk about what it's like to go through a syndicate funding round and as a founder. And we've got Jason, co-founder of Cake Equity, a lot of experience with fundraising across multiple platforms. We might wait a couple of minutes just to let a couple other people join the call. I'd really love to know where you're joining us from today. We've got a pretty informal panel structure to the conversation today. So that gives everyone a chance here to actually throw in the questions that they really want to see answered. So throw them in the chat and also let us know where you're joining the call from today. So we'll do that and wait a minute and we'll get going. So we've got a bit of Australia covered with the panel. So we've got Stew in Brisbane, we've got Gabby in Sydney, Jason and I are on the Gold Coast, and we've got Karen in Adelaide. So yeah, got a fair portion of the country covered.
Axel's back in Sydney. Good to see you here, mate. I was just chatting to Axel the other day. He was all around the world. So welcome back, mate.
Awesome.
I wonder if there are any syndicates in Nigeria, Axel. We were talking about Nigeria the other day as Cake expands. So interesting learning how all these different markets work.
We've got about 5 investments in Africa, so a few in Nigeria. Happy to chat if you need.
Oh, I'm so excited to chat to you about that, Stu. I know one of yours is Chipper Cash, right? Obviously going ballistic, and several of those countries are really going from strength to strength, aren't they?
Yeah, it's a very sort of vibrant time in the African ecosystem. Just a lot of like infrastructure and sort of, I guess, just people going from offline to online. Such a large population have been sort of underserved, I guess, in technology, and so we're just seeing like mass adoption, like really crazy growth across that ecosystem. So very exciting place. We're looking at it as like a little subsector of like our emerging markets of focus, in addition to Australia and New Zealand and the general sort of lens that we have on, from when we're reviewing companies.
Smart guys up there at 1013. Nice to bring that connection, into the role here too for you, mate.
Yeah, that keeps us busy for sure. It's great.
Let's kick it off. From a Cake Equity perspective, we run a lot of events, and this one is part of a series of events that we're actually trying to showcase for founders around the different sources of funding for startups. We kicked off a series last year with one on angel investing. We've done one recently on crowdfunding. We've done one on family office funding. And today we're really excited to be talking about investment syndicates. And some people will be very familiar with the term. Other people might be sort of sitting there going, I really don't know what it's about. And so whether you're actually know what's happening in this space and you're actually preparing to approach a syndicate to actually pitch to someone like 1013, or whether you're actually early on trying to work out what they are, it's really, you'll get a lot of value out of this call, because we're going to go through and talk about what syndicates are, how the Australian market is versus, say, overseas markets in terms of the development of that. Plus, we'll actually talk about the journey of a founder and how you actually prepare to actually pitch to a syndicate and successfully to raise to actually supercharge your startup. So that's what we're going to focus on today. It'll be pretty informal, as I said. It's a panel discussion. So I'd like to kick things off. I'll maybe hand over to Karen first, and then Stu, and then to Jace. If you could do a really brief intro of yourself and where you're from, And then after that, I'll throw back to Stew, and maybe you can give us an overview of what are investment syndicates and how they work from a fundraising perspective. So Karen, if you can go first with a brief intro, that'd be great.
Sure. So we're in an interesting position. We're in audience measurement, and we find ourselves with the deletion of cookies in a perfect storm for a new measurement category to sort of come in and take over what's legacy currency. So we're in audience measurement, specializing in human attention. So we build technology that enables us to collect essentially how much attention you're paid through computer vision across all the major socials, web and television, and we've done so in 10 countries. So we collect attention data, which then feeds products, which then feeds the ecosystem into a new currency. And I'm from Adelaide at the moment.
Awesome.
That's when you asked me.
Very cool. Should be popular at the moment.
Yeah, exactly. South Star coming soon. So yeah, so my name is Stew Glynn. I'm the managing partner at 1013. So I believe we're Australia's largest syndicated investment platform, closing in on 500 investors. I think we have about 470 investors, high net worth individuals from a whole mix of sort of backgrounds, whether that's corporate scale-ups like Canva and Afterpay, folks like that, people that are ex-founders or current founders themselves looking to back like the next generation. And so we have a deep network of investors. We were lucky enough to lead investment into Amplify Intelligence with Karen and the team last year, and they're doing some really exciting stuff. So that's the style and type of investment we've been doing at the early stage. But yeah, we've got a team of 12 of us now, mainly based in Brisbane, and looking to expand with another sort of 5 hires in the next couple of weeks, or kicking off some hiring in the next few weeks. So that'll be exciting as we build it out. And yeah, we've invested in about 30 companies so far over the course of the last couple of years, and about closing in on 55 million in capital deployed or invested into companies across the board. So been an exciting time, and the emergence of syndicates. So happy to dive in today. It's gonna be awesome.
Thanks, Chief.
Yeah, just quickly. So yeah, Jason, co-founder of Cake. Yeah, I'm not going to do a big intro. I'm really here to learn more about syndicates from these guys. We did get a syndicate on our last round out of the US, so I'll share a bit about that as well. And obviously we work with angels and VCs and syndicates, right across the Australian ecosystem. So I'll try and help to provide a bit of insight from that as we go through today as well. I'm also a member of the 1013 syndicate, so just thought I'd throw that in there as well. Doing a great job.
Awesome. So Stu, do you mind kicking off? Maybe give an overview of what are investment syndicates, even what are members to a syndicate. So it'd be great to actually if you can kick us off with that.
So syndicates, like in their essence, are just a grouping of investors, and so effectively it's generally a collective of investors investing in via one entity, so one line on the cap table, generally managed by another group or a syndicate lead. And it's not the same as sort of crowdfunding. I'd say crowdfunding, generally their customer is a startup, and effectively they will, so you've already done a session on that, they will help package up an opportunity and send it out to their investor base, but effectively their commercial model is usually I guess charging a percentage of the transaction with the startup. In a syndicate, it's basically like, it's very hard to sort of say exactly syndicates are pretty broad, and in essence you're grouping funding, but the different types, like what they look for, stages they invest at, investments that they like, are all very different depending on who the syndicate lead is and what sort of platform they are. So I can give some guidance on like what 1013 looks for and how we view ourselves in the market, but that might be very different to how Launch, who's like Jason Calacanis, who's invested in Cake, or it might be different to other sort of Australian syndicate investors. But in essence, it's a collective of investors that bring different things to the table, and we try and make it easier to invest in a company without in Australia, for instance, you have a limitation of having 50 shareholders on your cap table. So therefore you can't get the benefit of having this group of investors behind you without having some form of, collection of all of them through one entity. And so, and in essence, that's the start of what a syndicate looks like. But then obviously people take their own sort of versions of that and take it to market. So I'm happy to sort of dive in and share more on like how 1013 works and what the benefits that we sort of say are to both the founders as well as investors and how it sort of works. But in essence, it's just pooling of capital, at its underlying sort of level.
Fantastic.
Quickly,
So,
before we dive into that, Stu,
Yep.
so just from my perspective, I think syndicates are just increasing in relevance. You know, from a founder's perspective, in what you can achieve. The structures are much more established than ever before. The amount of capital you can raise is better than ever before. Just comes up in conversations again and again in 2021, 2022. So very exciting from a founder perspective to see that, and you know, leaders like 1013 are playing a big part in that. That's awesome. Couple of other side comments on the structure. Some of you might have heard of putting together a syndicate purely for the benefit of saving your cap table. So as Stu sort of mentioned, sometimes you just don't want 20 or 30 investors on your cap table because it's sort of not that cool to manage ongoing, and later stage investors can sort of appreciate it if the number's a bit smaller. So you can put together a bespoke one-off, syndicate vehicle. You got to talk to lawyers about that. We're not going to go into that today. There's no lawyers here, but you can go and do that. So that's something, that as a syndicate, we're not really going to talk about that today, but you put that to the side. So you can put together a syndicate like that. And yeah, I guess I just wanted to sort of highlight that as a side thing. So we're not really going to cover that. We're going to cover, I suppose, the syndicate model, with pooling investors together. And Stu, maybe you could also help the guys understand, I guess, how a syndicate is different to a VC or a fund, because it's sometimes perhaps not obvious. When you're approaching how it might be different.
Look, I think we think of ourselves as a hybrid of there's historically been angel investors and sort of a group of investors that potentially say there's the Brisbane Angels or the Gold Coast Angels, and that's a collective of folks. Generally, companies will come and pitch to them, and then someone wants to put their hand up and say, "I want to lead this deal," as in I want to do the due diligence, and then they'll all get in the room and sort of be pitched to by a founder and sort of decide on whether they want to invest. Or less informally, those angel investors will go and meet up with a handful of founders and decide where they want to invest. But then that's individual tickets, so them investing directly as on the cap table of that company. And so we saw, I guess, that model. And then there's the typical VC model, which is you go and raise a bunch of capital into a collective fund. So it's pooled already, at the high level. The LPs or the investors put their capital in, and they sort of, get called on a couple of year period, and then they make investments based on their thesis. And then where we think we sit is kind of in the middle. We're like a hybrid of venture capital in the sense that we try and bring the best of both sides of this. So we try and bring the value that you get from having a lot of angel investors sort of behind you, and alignment of these people that are very well credentialed, usually pretty time poor, but successful in their own right. Can help the companies with introductions to future customers. They can potentially help you on recruitment or referrals. And even if they just are best brand advocates for you in the market, you've already got, in essence, a whole bunch of people that are sitting behind you that want to see you succeed because they're aligned as an investor. But then you don't have to go and jump on the phone and pitch to 50 different people to get those 50 people invested in your company. But then on the flip side of that, I think the thing that you also don't want as a founder is you don't want to have for those 50 people on your cap table, because you have to get all their signatures, and there's a bunch of rigmarole around that kind of aspect. And so in essence, we've tried to say how do we make it as easy as possible to connect these two things, which is one is all the angel investors who actually want access to great, exciting companies, but on top of that, and supporting the next generation of entrepreneurs, and get the learning of actually backing these companies and their business models, and seeing how they progress. But then not having to go through that whole sort of process. And then on the VC side, it's we actually have a team, as I said, of 12 of us. So arguably one of the, I guess, middle of the road in terms of staff size in Australia, in terms of the venture sort of crowd. But we basically have a view that we see ourselves almost as a VC to when we're talking to founders. So we want to basically say to them, if we tend to shake hands with them on deal terms, and Karen can sort of give you some guidance of how we went when negotiating and sort of how we came to agreeing a deal. But in essence, we want to sort of commit to that to those founders that we can fund them. We want to operate like a VC. We basically are competing for really good companies and backing the best founders. And so we don't see it in a bifurcation in either you pitch to a syndicate or you pitch to a VC. I think that both of them are sources of capital, and you're going to see which one is the best suited for you as a founder. And we say, I guess our pitch is that we have 450 investors that are some of them are operators, some of them have done go-to-market and international, in different markets. Like there's a whole bunch of, really amazing sort of experience. And so we call it network-based investing, and there's a collective more value in that. And so, yeah, basically we've tried to build a hybrid model that takes the best of both parts of what a VC looks like and what a angel network looks like, and put them into a function that we think is valuable to the founders and the investors on both sides. So we are almost like a marketplace, I guess.
Fantastic. That's a good overview, and might be a good time to Karen, maybe for you to talk to the experience about the process that you went through when you were actually raising, even to who were you actually talking to? Were you mainly focused on syndicates, or were they a number of sources of capital that you were actually trying to tap into?
Yeah, I mean, we're probably a little different. I mean, the business is sort of running for 4.5 years, bootstrapping before we made a decision to actually raise capital. So for me, I was essentially learning the difference along with the pitches that I was doing. And, it was, to Stu's point, I really didn't understand the value of a syndicate until I sort of started to sort of talk to him around the differences. Because to me, it was, who's coming to the table with the best offer. We knew we had an amazing business, we wanted to scale. So the whole point, we're post seed. So we were past the point of getting traction in the market. So I wanted to make sure, one of the key things for me from day one was that, we weren't exploited. We weren't the typical startup, but also that we work with great people. And, obviously Stu is that. But, for me, I didn't really go out going, I want to work with a syndicate because of these reasons. But I did actually end up pitching to quite a few VCs. And then when Stu came along, I've just made some notes. There are some amazing benefits. So firstly, I totally agree around the cap table piece. We've just uploaded our into Cake. So, of all people, I kind of get that. I didn't want to have to put 300 people into that. But also what I love about it, so for background's sake, I have a audience measurement PhD, so my background's research. So what I love about the whole syndicate piece, which, Stu, welcome to use this language, is that it's not a sample of one. So what I love about it is, you're not the judge and jury of my future as a single person going, yep or no. You sort of said, look, this is interesting to us. We'll put it out to the members, and then the members come in. And in our position, in our case, we were, I'll never forget the Saturday morning call at 6:30 a.m. where you went, oh my God. So what I think that does is it sort of really reinforces where the business is going from someone that's not, I'm pretty sure that Stu knows a lot about the attention economy now, but before that he didn't. So what I loved about that is, in a sense, it's market research at its finest. You're getting sort of an understanding from a broader group of people that in some cases are like-minded, and they can go, oh my God, this is the hot space. And that's the position we're in. We're in an emerging category. The third thing, and you've already mentioned this, is the meeting of the minds. So we've had a couple of the members actually contact me as the founder to sort of connect the dots, because some of them are in my space. So those are the things that I love about it. And then of course the team is just super helpful. We're heading into the next round now, and the value I get from a team like that is priceless.
Fantastic. Great overview. And Stu, would you, and from your perspective, do you see there's the process-wise, is there, do founders need to be thinking differently about talking to you and the process that go through to the VC? Are you able to actually just talk a little bit about what might be different, if anything, about that? Yeah.
So we try and streamline the process so that we have, again, can compete with a VC in terms of from an investment perspective. So but the way that we sort of do it is similar. We go through, I guess we are ultimate decision makers on what goes out to our investors. So effectively we have our own sort of due diligence process and investment committee where we basically agree on, we love this business. We have the fortunate sort of background that Steve Baxter is one of the other partners in the business, and Steve often he's investing in every one of the deals that we do. So there's alignment there, which is helpful, but he also often tends to, in the seed stage, look at underwriting deals. So then we can say to we can say to a founder, hey, we are good for X amount of dollars, and we'll let you know if we oversubscribe, we maybe would be happy to take further allocation in the round, etc. But at least we can sort of look them in the eye and say, look, we're good to fund X, which is sometimes a bit of a different sort of model depending on each syndicate. And then what we do is like agree on a set of terms, and then what at the same time during our due diligence, we'll write an investment memo. And so the investment memo is kind of effectively our view on our thesis on the company and why we love it and why we want to invest. And so we will send that over to the founder. And I remember sending it over to Karen and saying, like, can you review this and tell us this is aligned with your business and makes sense, and like, you know, there's a few tweaks here and there, but like it was broadly aligned, which is great. And we tend to do that, so get alignment. But also it's good for founders, in my view, and my experience is they get to see how others externally understand their business, like from someone that is not, you know, deep in the attention economy, which Karen is a world-leading expert in, you know, someone who's only seeing it for the first time from like, you know, being a generalist fund like us. And so, yeah, we basically put out a deal via an investment memo to our investor network. They're all under NDA, so all of our investors basically have confidentiality sort of, you know, I guess protections to make sure that sensitive information that we share, because we do like to, you know, have a fully formed sort of thesis and reason why we're investing around whether it's team, traction, you know, market size, competition, et cetera. And then we have to, and then the validation as Karen said, is the fact that people then allocate their hard-earned money into that deal. So it's not the same as a fund. Like when a fund, you put money into the VC and you say, yep, we're good to go. We like you as the management team, you know, as the sort of managers, and we like your thesis, and so we're going to back that. In this scenario, it's like you're making your own decision on each deal by deal as an investor. But we put out a memo, and usually we put out for 5 days on average, but we usually close them quite quickly actually at this point. But I think it's a busy market, lots going on, so there's a lot of interest in the category. And then once we get allocations in, then we basically do a deal with those investors. So we'll do scale backs and get everyone aligned and make sure that everyone gets a piece of action, and then effectively we will call we'll call all that capital in. But we try and get that done in pretty much usually 2 weeks from start to finish. So the day that we launch a deal to the day that we've sort of collected all the capital, as long as we've got, I guess would you say, legal documents in place with the company, then we can do it in the same fashion. And a lot of people say, oh, like, you know, you're gonna have to get 50 investors to go and give you this capital. Like, you know, is it going to take you months to do that? So we've trained our investors, you know, I guess like when we say train, but conditioned our investor base to trying to say like, hey, we're putting out deals. Founders' time is important. And also, if you want to get into the best companies, you have to act in line with the market. And so you can't expect that, like, if you say you got a 3-month process, that you're going to be able to win, you know, and back the best founders, because they will have solved the deal and already done that, you know, long before. And so we try and get that done as quickly as we can. Obviously, there's things that can push out with legals and things like that, but generally, most of our investors act pretty quickly on like allocating in and then signing documentation. So yeah, I mean, we have almost 2 deals to do on every deal. We do a deal with the founders, and then we do a deal with our investors. But the benefit of that is that we're not out fundraising for, you know, 6 months out of their 2-year deployment period, and we're basically just building our, you know, the depth of our investor base continually. And people get access to all the deals that we do as soon as they join up to the investor network. So they get access to exciting companies once they're online with us.
With 450 odd members now, nearly 500, those deals are pretty qualified when they get to them. Do pretty much the majority of them get funded, Stu? Like,
yeah, touch wood, we haven't had a miss yet.
Yeah.
Which is good. Yeah. Like, I guess like we don't want to have a miss ever. So I guess it's like, yes. So like we push pretty hard to not have that problem, and then we also sort of taper what we allocate, you know, what we request as like an allocation depending on what we know our investor base is sort of, you know, generally interested in. So
right.
Yeah, we don't want to overcommit to founders in particular.
I'd love to just get a little bit, you know, you mentioned earlier on that, you know, there are different thematics for different syndicates. It would be great if you could share a little bit about, 1013, what types of startups, what stage you're actually looking at supporting them, etc., so that people understand a little bit more about what types of startups that you'd be interested in.
Yeah, so I'll answer this in 2 parts. So one is we have 1013 as a whole, which is effectively we have an investment team and including Steve's capital. And effectively, we generally look to pre-seed through to Series A. So like that's our general sweet spot. So I'd say seed is like target focus, average check size is about $1 million on entry. And we invest in all types of generally globally scalable software, like you're looking for like market leaders, looking for sort of certain business models that we like and have built muscle in over the years. So things like product-led growth, like our software as a service with a bottoms-up sort of sales cycle. We've done a lot in fintech, we've done a lot in API infrastructure. And then we've also done a bunch across the board in sort of certain industries. So like e-commerce, we've done quite a lot in e-com enablement and stuff like that. And so in essence, like, I guess we've built sort of internal theses on a bunch of different things. And like one of them is like emerging markets, for instance, and sort of there's a bifurcation or like an arbitrage there on the amount of funding that's going into those markets and the actual growth and opportunity of those businesses. And so we've been spending a little bit more time on Africa and sort of Southeast Asia. But so like that's just our typical lens. But then I'll also say we've launched a new program, which is basically sub-managers or venture partners within our sort of group called Maverick. And we will basically partner with folks that have great sort of deal flow and networks and want to basically start building their own track record as investors. And so they will be like almost a syndicate lead on 1013 with us. And so deals still have to come through our investment committee, but we don't necessarily, and we'll still do a level of due diligence, but they will be like the lead investor sort of with a commercial relationship. And what that's done so far is like we've launched with 2 Mavericks so far, and we're hoping to get sort of 5 or 6 by the end of this year. And we've probably doubled our deal flow off the back of that, just on the basis of those people being out in the market, sort of, you know, basically talking to founders, and then we sort of have a you know, share an economic arrangement. But what that does is probably answer your question is so that's widening our funnel of deals that we would typically do. Like, you know, in essence of like, we have certain things that we sort of like as 1013, but then over time we're expanding that because we've got a diverse investor base across the board with wide range of interests. And even the other thing that's interesting is a lot of people think that syndicates, because there's a lot of angel investors, then therefore that means they're early investors. It doesn't necessarily mean that, to be honest. Like, so if you've seen like AngelList, for instance, in the US, which is the biggest sort of platform, which has a lot of syndicate leads, those AngelList like syndicate leads will invest in all the way through. Like basically they'll have small allocations in Series D or E rounds. They'll also be doing pre-seed deals. So depends on their, you know, what they like and what their thesis is. But the interesting part that we have is that we have flexibility. So we haven't raised a fund on a certain mandate, and so we're not caught into the fact that we have to do this because we've said in our original prospectus that this is what we're going to do. That's a blessing and a curse because we have quite a wide arc of opportunities, but also gives us, you know, ability to be opportunistic and dive in on the exciting companies that we think are like category creators, like Amplified. Yeah,
fantastic. And so that yeah, Karen, you mentioned you were actually lining up for another raise round as you continue to scale up journey. So, you know, I'm not sure whether you can talk much about your plans there or.
It's happening sooner than we thought.
Yes.
We're in an interesting position though, because literally the category is exploding and we are right in the middle of it. So it's more that we're being brought along with that. So we have to scale because there will never be another time. It's like government changing regulation and then something happens and then there it is. And that's kind of where we're at. So we weren't planning to so quickly, but we have managed to sort of get sales to the platform pretty quickly so we can sort of demonstrate growth. So we're at a point where we have to run with what's happening in the globe. So that's what's happening. So in terms of my position, Stu will know this, we're struggling in terms of time. So at the moment, we're still sort of pulling together, you know, final sorts of information for people, but we've had quite a few already sort of race forward. And, you know, even, you know, the publicity around, you know, the 1013 investment sort of, I've had 2 sort of following me from that day, one from the US and one from somewhere else. So it's just a matter of kind of getting Stu's help and getting it together and going again.
And so, Stu, is it quite common that you're actually participating in follow-on rounds? And is that sort of generally one round, or, you know, you said you've got quite a lot of flexibility? Yeah,
I'll give you some examples. So like, and it just depends on the business, but in essence, as I mentioned, we like the exciting thing that we have with our investor base is that we're not like with a fund, you kind of have like a deployment cycle. So you'd say, look, I'm going to invest like 40% up front in seed stage companies, and then the remaining 60% will be for follow-on investing. Whereas for us, we have the opportunity to kind of on a deal by deal, each company that we invest in, we can kind of make our own sort of investment decision of like how much follow-on capital you want to sort of deploy behind them. But like the general sort of arc is that we would love to follow on and continue to support our companies as they get to their next rounds. And so we want to invest early and then continue to support them as they grow. And so, for instance, like Mr. Yum, we led their sort of seed round of like 2.5 million. Then we led their post-seed round of like close to 9 million. And then they raised like an 89 million Australian dollar Series A, and we followed on with like sort of 10% of that round. But then they had two major large investors sort of leading like co-led the round with like sort of 60 million of that. And so, look, we continue to support, and invest behind the companies as they sort of grow, and we love to. And the great part of that is that some, investors within our network might have invested in the first round or not invested in the first round, but then they get to have another investment opportunity. Like if the company starts growing and maybe it proves out proof points that they didn't like on the first round, they still get to have a look at it on the next round, like most of the time, depending on what pro rata we get. And we still manage to like offer, I guess, pro rata up to all of the first round investors to say like, hey, you were the first people to back that company, so you get first dibs. And then after that, if there's still allocation left over, if we're going for a bigger amount, then generally we'll open it up to the wider network again. Just depends on the dynamics of the future round. But and then we work very hard to try and help like our companies, be successful on their next raising. So we're very collaborative. I guess our whole thesis with having a lot of investors behind us is we call network-based investing, and there's more value having a network than not, and being collaborative. And so we work with a lot of different VCs, both Australia-wide and internationally, to try and help our companies sort of on their next part of their journey. And so, yeah, we'll be helping Karen on their sort of process, I'm sure.
We have already. So the example there is as we were pulling together the next, investment deck, which is literally only 4 months later, in true me fashion, sort of put it together as an industry researcher and an industry, really connected. And then we sent it over to them, and I spent a long time changing it up because he went, no, waffle, no, there's the flow, and it's wonderful. And that's, sort of the traction we've already got from that. So it was helpful. It was painful, but it was helpful.
Felt bad. Sorry, we were like, oh, this is a better way to do it.
No, it was really, really good. So that, like I said, I'm not, one that's done years and years and years of this. So for someone in the area, to have someone like Stew and team sort of help me, and Lachlan, and to help me through that process, I couldn't pay a consultant enough per hour to help me.
Yeah, I mean, look, I think the reality is, even if you have done years of it, like having people to tap into and give you that feedback is super important. And fundraising in a startup context is very different from, every other context you'll do it at. My background's equity markets, and so I've done it at the large end of town, but it's like learning a new language, coming in and actually doing it in the startup space. And so Jason, that might be a good one to throw to you, because you've got a lot of experience with capital raising yourself. You've had some experience with investment syndicates with Cake, but maybe even a good thing, I think you made a point before we started the call about like when you started fundraising with Cake, like there wasn't really a lot of syndicate available in Australia. So maybe you can actually even start back there, and how have you seen it emerge?
Yeah, I think it was really just the angel groups, Brisbane Angels, like whatever angel group in your area. I don't think there were any syndicates. I'm sure that AngelList was here in some way, shape or form, but it's never really been very prominent or prevalent. I certainly wasn't hearing about it in any capital raising discussions, 4 or 5 years ago. And I think the last 2-3 years particularly, it's become very relevant space. Really excited to see the progress of 1013 as a Queenslander. I think it's been a real shining light for us up here, not to blow not to pump Stew's tires up too much, but it's really great. It's such a fantastic additional avenue for founders to go and raise capital. I find as well, and look, this certainly was the case with Launch when we raised our sort of Seed Plus last year. There does seem to be an element of being able to move quite quickly. And I think that's something that founders should be aware of as well. The communication seems to be really, really direct. And then, from our actual experience last year, we ended up getting Jason Calacanis as our lead investor, and so he invests sometimes as the syndicate, and sometimes he invests himself with the syndicate as well, as like a double investment, which I think not completely dissimilar to Steve and 1013. That was awesome. So I guess was in. We're able to agree terms very quickly. He obviously understands his syndicate very, very well. He knows what he can promote and what's going to work. We were coming off the back of a successful StartMate stint, and so we're in pretty good shape, which was good. And the process was, well, aside from having to go, we had to become a US company, which has its pros and cons. It took us a long time, cost a lot of money, and become slightly more grey after that, which again is another reason to stay local if you can. But certainly nothing against US investors. They bring a wonderful amount of firepower to the ecosystem as well, which is obviously very valuable. And so we, they did a lot of the heavy lifting for us, and we just sort of filled in a few of their forms, pitched one evening, and then we were oversubscribed very quickly. The whole process ran really, really well. We now have, as Stu mentioned, the network effect. We've benefited from that all along. We have a really, really big cap table, which kind of has been a huge pain in some ways, from an admin perspective, but has been awesome in other ways because we've got a lot of supporters. We've had a lot of friends. Lots of these angel investors have helped us out in various ways over the years. We're very grateful for that. I just did the first update, or one of the first updates for the launch syndicate the other day, and I had a ton of emails back from people all around the world that I've never met, looking to get their portfolio companies onto Cake and help us out in various ways, even feedback on the style of my update and stuff like that. But it's all very helpful. So I think syndicates are really pumping. Personally, I know there's a bunch around, and it's a fast moving space as well. I think people are really starting to work out how to make it work well, and I think it's a credit to to the people out there really trying to understand the model well, make sure that it works for founders, and it's good time for syndicates, I reckon.
Yeah, funnily enough, we so Jason Calacanis, and this is probably where the genesis of a couple of us in the syndicate space in Australia. So Kylie, who is Flying Fox Ventures, and we ran a group to taking a bunch of sort of LPs or investors over to Silicon Valley, and spent a week over there with a bunch of investors. So it was myself and Steve sort of helping manage the process when we used to have River City Labs and the Startup Catalyst sort of group. We went over to San Francisco and I spent a bunch of time there. Kylie came on that sort of mission, I guess you'd say, and we actually had a whole day sort of session with Jason Calacanis, or Jason on just generally angel investing, I guess, as a sort of learning more about how to do it well, how to do it properly, et cetera. But we dived into a lot of questions just offline about the syndicate model and how that will work, and the pitfalls and things like that. And so we learned a lot off the back of that, and both of us sort of spun up similar sort of offerings over time. And then, it was great to see that that was probably 2.5, maybe 3 years ago.
Pretty cool. I think he's got about 7,000 or 8,000 now in his syndicate, so something to chase, mate, too.
I know, one day that'll be a lot of investors to manage, but who knows? We'll see.
So I think that's Stu, that's a good segue into kind of where do you see sort of the syndicates, for going in the future in Australia, right? It seems like you guys are pretty well established, but it does seem like we're still pretty early days compared to, say, a market like the US. So it'd be great to get your insights on where you think what's it going to look like in 2, 3, 5 years time.
Yeah. Look, I think it's early days on the model. In Australia, I believe there's a handful of players. There's us. There's Flying Fox, which has a mixture of a fund and thing. There are the GLX guys who sort of aligned with Innovation Bay. And so, yeah, look, there's an investable, and so there's a handful that do it, via different sort of like mechanisms. And there's also like Aussie Angels, which Cheryl Max recently set up to sort of help syndicate leads with a structure, sort of just set up and run their own sort of deals. And so we'll see a lot more of this, I believe. Like, and it's all accretive to the ecosystem. It's not an N of one, this market. Effectively, we're all different. We all collaborate. We're all frenemies, and we're all trying to invest in great companies. And so and support the next generation of great founders. And so I think you'll see a lot more on the syndicate sort of model. We're already seeing other sort of venture funds even doing a similar approach in the way that they like some are raising funds, but then also having sidecars, which are like syndicates, which is basically people opt in for like later stage rounds and things that don't fit into like their typical fund like strategy, I guess you'd say. So I think that like people have seen the success of it and are now working and now using that model to sort of build out and sort of be more flexible in the way they sort of invest. So we're pretty excited about it. We think it's like definitely it's a busy time, and there's lots of sort of movement, lots of interest, especially from the investor side that haven't had access to this category very transparently. You either have to invest in a fund or go and do it yourself, like Steve Baxter did like 10 years ago when he first started angel investing, and he was like, it was really hard. Like, you had to start building a team, and you if you're looking for not only returns, but also like learning and stuff like that, you want to be part of the community, and you have to invest a lot. So it's either you have to invest a lot of time or to get access, and I think like, syndicates have helped sort of open the door for that. So I think over the next few years, you'll see a lot more of it. And just even more interesting things, like when you think of like Sequoia, like one of the best funds in the world, has started like an evergreen fund structure, which in essence is quite similar to a syndicate structure where they have sort of underlying funds, but then they all feed up into the top sort of vehicle, and they kind of are consistently going to be investing in through multiple funds, et cetera, into different companies or the same company multiple times, different funds and things like that. And so I think what's happening is there's just the typical sort of go and raise a venture fund. That model is being disrupted slightly with like sort of innovation, I guess you'd say, on the investment model. And syndicates is one of those models. And I believe that like we're pretty bullish on that opportunity, because it sort of democratizes access. It's not sort of the ivory tower anymore. You're basically having a collective of really awesome people, and for us, I think it has network effects. So in essence, like the growing investors that are on our platform can help us source new companies, help us do due diligence on companies because they have a variety of backgrounds. And then once they invest, they're aligned and they want to help those companies. So then they, as you said, they will reach out and see if we can help out. So we recently launched a program called like Radar, which effectively is for each one of the investors that's opt in from an investment perspective. And I think we sent Karen's hers last week, which is basically like the investors that have opted in and like I guess a blurb on what they do and what they can help with, and basically saying like every company that I invest in, here's my blurb, and you can connect us up if the founders want to talk to me about go to market or whatever function or whatever background they have. But yeah, the general environment is looking it's exciting to see all what's happened in the last couple of years for sure, and I think it'll keep going. I think it'll just be recognized as another source of funding going forward. And I don't think it should be viewed as different to VC or different to angels. I think you should as a startup look at what your options are and pitch to all of them as in the targeted fashion that you can, not wasting your own sort of time, but like I think that they are a reasonable and sort of valuable source of capital, so they're worth being on the agenda next to VCs and next to sort of angel groups.
That's great. And practically, Stu and also Karen, I'd be interested in your experience itself. Does a founder need to be thinking they're going to pitch differently or to yourselves, to a VC, or is it very similar? I'd be interested to, Karen, to see whether you thought anything differently about talking to 1013 or pitching to a VC.
So given this was our first, I didn't think anything. I didn't know what I didn't know, right? Yeah. So, but the experience was vastly different. So, and as an older entrepreneur, one of my mantras is to work with good humans. So I was pretty drawn to the group because of, the model, which is we're here to help you. And that's quite different from not everyone, but the few that we did actually present to. It was very much, the arms crossed and, what is it that you can do for us? And, that's just not in my space. So it was didn't expect it to be so different. So I didn't know to pitch differently, but it wasn't a different experience. Yes.
That's interesting.
Hmm.
Stu, have you got anything to add? Yeah.
Well, I mean, thanks, Karen. Like, I don't know. Like, so like, I think like the general summary though is like when you're, we are still gatekeepers, I guess you'd say. So it's not like an angel group where you get access to or a crowd fund where you get access to a bunch of people as well. You know, once you get through, effectively, like I guess there is a filter, and we are the filter in terms of like, you know, that we still opting for as high quality as possible. We're still investing our own capital behind it. You know, with Steve's family office and myself and others, you know, within the team. And so in essence, like there still is I guess like a review process, and you still have to get to that green light. And so we try and run as, you know, very similar to a way a VC would do in terms of like due diligence and so getting a commercial decision. But yeah, I guess like, you know, we do things like counter pitch companies where we will basically say like, this is what the reason why we think we can help you. And like, we will actually go into some meetings and actually pitch them back why they should sort of go with us as an investment firm rather than others, and et cetera. So yeah, I'm not sure if that's sort of helpful, but like, look, I think you, as I sort of mentioned, when you're raising like a venture round, my view is that like you should try and fill your funnel like it's an enterprise sales process, and try and basically have like a fairly sort of regulated process of how you go about it, and to try and keep people on track and keep the process going, and minimize the amount of time, you know, as you as a founder spend on it, because it is sort of value destructive. You spend a lot of time trying to raise capital, and it's sort of a lot of times uncertain. And so you've got to, like, in our view, like try and plan it out and try and make it as programmatic as possible. And we try and help our companies to do that. But it's probably separate to the question of like, you know, I don't think you pitch any differently is probably the summary.
Okay, awesome. And Jason, do you have any sort of tips, like in terms of not even just specifically around pitching for funding from syndicates, but just any general tips in terms of actually for the founders around preparing to pitch? Stu made some good points there about treating it as an enterprise sales process and filling the funnel at the top. I know I hear you talking about that a lot, but is there anything else you'd like to add in terms of things that the founders really need to actually keep top of mind as they prepare for a fundraising round?
Yeah, so they're a big piece of work, and you know, it's really is a time commitment. So there's a few key things you really want to get right, and that process is probably the number one thing. Some of the major aspects of that I always highlight is, in the beginning, make sure you've got enough investors on your first list. I normally say you want around 10 times whatever you want to raise on that first list when you get started. And then your job as a founder is to talk to as many of those as you can and build rapport, build a relationship, and then try to get to the point where you're happy that you've got enough investors on that list that would like to see your deck when the time comes. You know, like when your round opens, you know there's enough investors that generally are happy to see your round and actually want to check it out. I think that's a major mistake founders often make, where they kind of like run through that whole process without checking that, making sure they've got enough support. So yeah, and then just run that second phase, you know, I guess as hard as you can. Make sure you keep the speed and momentum up through that phase, and then try and make sure you get investors that match your situation very well as well. I think Karen's point was bang on. You know, you got to know yourself, you got to know your company, your team, and you know what your values are, and try and align yourself up as best as you can when you do make that investment decision, because you're going to be working pretty closely with those people for quite some time. So yeah,
like inviting someone into the family.
Yeah, absolutely.
So we've got a couple of questions here. So one was actually about what stage of a startup you invest in, Stu. So maybe that one, and then there's a follow-on question there. I would just urge anyone, if they do have questions, now's a good time to do it. We've got about 10 minutes left, so I'd love to actually get some more guidance from you in terms of any specific issues we haven't covered off on. So, but maybe Stu, if you could answer that first one, or like at what stage do they have to have revenue, or what do you look at?
Yeah, look, I think broad left and right of seed is a typical. So we generally want to see a level of traction, but we're not necessarily tied to this. So like we made a handful of pre-even product bets. Well, when I say bets, it's like, I guess at that stage we're really sort of backing a team. We've only done that on a couple of occasions with people that we trust or like know relatively well from over the years, or generally that have a very sort of compelling pitch. But generally you want to see, I guess, some level of product in the market, team together, some early traction that can be the form of users, not necessarily be sort of revenue generating. And then obviously, as we're happy to sort of go later in the risk curve and sort of do post seed, which is probably amplified intelligence. They were sort of moving their model from a more of a service-based model into more of a productized, I guess, model. So that was probably part of the shift that they need to make as part of the funding round, and sort of take their offering to market in a sort of traditional sort of product B2B fashion and an API sort of opportunity. And so we're sort of supporting the team who are experts in what they did on that in that space to go and execute on that. And then we've gone up to sometimes later stage rounds. So it's, again, we're quite flexible. We try and, like, I guess, coming back to the thesis, we have a large array of investors and sort of people within our network that we work with. And we think that that's going to help us filter and get access to the most exciting companies. And so we don't really have to have a lens on like, they have to be seed stage and they have to have X amount. We basically try and look at every deal and its merits and the founders and why they're best placed to win, because I think at the end of the day, that's what you're shooting for, is like the outsized opportunity to back the right people that are actually going to execute like on a, on building a big business. And so that's what, most VCs are looking at, but that's like our typical lens, I guess you'd say.
Right.
Yeah.
Thanks for that. There's a question here from Myra. What are the commercials for a founder when working with a platform like 1013 versus VC or Angel? I'm assuming that is, Myra, you might be able to clarify that. Is that referring to whether you have to pay a fee or something like that, or it'd be worthwhile just if you could clarify that question?
Yeah, I think that's probably it. I'm not sure Mira wants to jump in, but yeah, I mean, look, in essence, like, we're no different from a VC or an angel. So in essence, like, we don't charge startup anything. So the commercials on our end are like, we operate sort of like a fund, I guess you'd say. So a typical fund model is a 2 and 20%, like, so 2% management fee over the course of the life of a fund, and a 20% carry. We have like arguably what's called like a 1 in 20 sort of model, I guess. I'm happy to go into the commercials, but effectively our investors pay to invest in each company via like a management fee and a setup fee for us to do the due diligence and legals and stuff like that. But there's no sort of aspect of that being shared with the company. So the founders, if we agree to invest $2.5 million, then we'll be, we'll sign documents for $2.5 million and wire you that amount of capital.
Okay. And there was just a follow on, like, expectations with STACE and term sheets. I don't know whether you want to go into that or not, Stu, or actually even what instruments you actually do invest via.
Yeah, like, I mean, this is market driven, and in essence, like, we invest on safes and we invest in price rounds, convertible notes, like, whatever it is, like, we're as long as it's a pretty standard sort of format, we're generally happy with it. We're not too, as long, and we generally, things we care about are like information rights, the ability to continue to follow on and and support the investors of the companies that we want to support. We're not very strong in terms of control and like forcing people to like have like anything around like sort of veto rights and things of that nature. In essence, we try and be aligned with the company as best as possible and the founders, and support them and not be sort of overbearing, whilst having a level of like the right, just level of sensible protections to make sure that we can get access to information and understand how the company is tracking. And but usually that's just a two-way street, and founders are very good at sort of providing that information and transparency and stuff. So it's pretty standard sort of stuff, I guess you'd say.
Yeah, great. Any other questions? Just feel free to throw them in now. That'd be great. Karen, we talked a little bit. You don't have a massive cap table because you've been bootstrapping, but we did talk a little bit before about the fact that you've just come onto the Cake platform. So this is our opportunity to actually talk maybe a little bit about that. It sounds like that, really, even though you didn't have a big cap table, you certainly have a pretty active ESOP plan in terms of building and rewarding your team. So it wouldn't, if you don't mind, if you could just talk a little bit about what that process has been like for you, that'd be fantastic.
Yeah, I mean, it was actually the ESOP that drove us to Cake versus the cap table management, because exactly that, we don't actually have a very diverse cap table, so that's easy to manage. You know, we already have quite a few staff, and the plan is to grow, and part of the prereq essentially to come on board with 1013, as you would expect, was to have a proper ESOP plan. And we'd never been in the position to do that before, because we've been going for a while. We had tax implications and things like that. So we had to work through it with lawyers and how it might work. And the government luckily has made it nice and simple for us. So as a founder, I put aside a sizable chunk, and it is literally being uploaded with the lovely Shannon at Cake as we speak. And we've now built a UK entity as well. And I'm told today that they have a capability for us to sort of, we've got 3 employees over there. So I'm excited for that. But yeah, so for me, you know, anything that makes my life simpler, and anything that makes it, you know, sort of automatic and systematic, I'm on. So it's been a really great experience. And also what I loved about Cake was, I mean, we haven't done this yet, but you don't need an in-house change manager to explain to everyone what it means. So, you know, we've had staff here for a few years now, and all of a sudden they're going to get these options, and we can be able to watch it grow. And the Cake platform has all of that sort of communication built within it. So I'm excited to utilize templates, thank God,
yes, yeah.
Instead of having to do it myself and, you know, adding it to my list or hiring a change manager.
Yeah, well, I think that's super important, right? I mean, part of the value is new automation and saving, you know, work, setting it up and then running it. But equally important, the last thing founders want to be doing is giving away equity and not having people understand or value it, right? So being able to bring it to life for employees is super important, and something that we're really passionate about trying to help out with. You know?
So just a piece of advice for anyone out there. So we've actually accounted in our ESOP for up to 500 staff. So what we did in Excel originally was sort of build out a series of sort of scenarios, which were early, middle, late stage employees, and what that might look like. And we tried to align ourselves, because, you know, we're technology, so we're competing with a lot of other companies, particularly in the US. And so we tried to make sure that it was generous, but not too generous. But so there was a lot of research that actually went into the Excel spreadsheet around what each group, I've codified how long they've been here, to what job they do, to what stage they're at. And then that then is being uploaded to Cake as we speak. So the rest of it will be easy for me.
Yeah. Once you get,
sounds like we can learn a bit from you, Karen.
Don't ever ask me about my brain. It's always, planning with spreadsheets into my life.
Thanks, Karen. Stu, there's a couple more questions there. I don't know if you can see them.
Yeah, I can see them.
Yeah.
Cool. So thanks, Dan. I'm not sure if it's Dan Rosen that I know, but there is someone I know. So hey, mate. If that's you, it's not. Hey, mate. It's a $1 million parcel. Like, look, I think what we found is earlier stage deals. I mean, look, we definitely do investments sort of sub-million. We're on, like, I guess we have some seed deals that are like between 300 and sort of 700K, I guess you'd say, and we're happy to sort of do those sort of deals. The challenge that we have, like, just is that we have quite a lot of investors online now, so it doesn't sort of divide very easily when you have, you know, that number of investors. So if you have 50 investors and you get up to 300K allocation, sort of whittles down quite quickly from a subscription amount perspective, but that's not a problem that sort of founders should worry about at all. We want to work with great founders, and we're happy to support, you know, over the long term. So we'll continue to support, you know, and hopefully, you know, invest behind them as they grow. So we're not too worried about that. So yes, in short, we're happy to take smaller minimum sort of investments. Abby asked a question around whether we do hardware and robotics. I'd say we're not super strong, if I'm being transparent, on just general hardware. We've done a couple of deals in the space, which is basically like hardware enabled SaaS. So we've done a company called Vitruvian, which is like a smart weights product, which is direct to consumer, like in the gym space. And we've done, we're about to close another one, which is in the sort of grocery space using sort of machine vision, etc. Which is exciting, but we haven't been sort of super involved on the hardware space. In fact, we've done one through Jason's syndicate, in Jason Calcanis syndicate in the US, called Cafe X, which is a robotic-based sort of coffees. And then, yeah, I think so.
He's always talking about that. That's cool.
Yeah, it's quite funny. If you go to San Francisco, you can go get an automated robotic coffee. I think most Australians wouldn't like it, to be honest. Like,
yeah, they've got low standards to pass with their robotic
exactly.
coffee. I'm not sure down in Burleigh that's going to fly.
Yeah, 100%. And then, yeah, I think the last question was from Jess around to Jason, just around, you talked about having 10x of how much you want to raise really before you raise. So is that, yeah.
Yeah, so I'm just going to share my screen really quickly. I know we're out of time. So I've put this link in the chat. So can you see this or not? What can you see? Anything, Carl?
I can't. Yeah, I can see it now. Yeah.
Oh, geez. Okay. I'll just run over. So I have shared it in the chat. Please get the link because I don't want to run over too much. So basically, the way I see it is you want to list all your investors down that you know, or just Google it. Look at the Airtree open source investor list in Australia is the best one. Find the best list you can find. I know Cheryl Max got some great resources. List out the investors that invest in your stage, in your niche, and then estimate or find out what their first check size is going to be. So your first job is to build a big list. Your second job is to qualify that list down. So they know you, they've seen your pitch, they're happy for you to pitch them, and you roughly know what their normal check size is. So you want that to be around 3 times or whatever you're trying to raise. And then you start raising. This is an important sort of, I guess, capital raising, enterprise sales process. So I've given you the tool there that we use, and it's pretty helpful to help you just understand that dynamic. Doesn't have to go that way. It just helps you stack it in your favor a little bit. Yeah.
Thanks, Jason. In case you can't get it in the chat, we'll also put it. We'll send it out to you along with a recording of the session. So we are out of time. Thank you very much to Karen and to Stew and for Jason for giving up your time today. Great. It's great to see this space really emerging, and it's certainly. I've had the conversation with Karen from Mr. Yum about her experience last year going over to LA and sitting beside someone in the cafe, and they're talking to her about, what she's doing, and then basically offering to invest in her startup, right? And certainly in the Australian market, there seems to still be that quite a gap in terms of that early funding for startups, and you guys are playing a super important role in terms of connecting the investors who want to actually invest in this space with the founders. So great, Karen. Good luck with the next raise round. And it sounds like you're in that great situation where you've got a very nice problem. You're scaling up that quickly that you're having to raise again so soon. So congratulations on your success and all the best for that. Stew, thanks for your time and for the work that you guys are doing. And Jason, yeah, thanks for all your insights as well. We'll send out a recording. If you've participated in the call today, you've got access to some discounts on the Cake platform. So we'll throw them in a follow-up email for you as well. And please feel free to hit up Stew, and I'm also sure Karen's happy to actually answer questions on LinkedIn if you do have further questions post the call today. And and feel free to reach out to ourselves as well, either Jason or myself or Gabby, if you have any questions about the Cake platform or need any help with employee equity or with the capital raising side also. So thanks again for joining us, and thanks everyone. Talk soon.